Commercial real estate investment can be confusing, especially when it comes to evaluating the performance of a property. Two common metrics used to assess the financial health of a commercial property are cap rate and cash on cash. However, many real estate investors are often confused about the differences between the two metrics and their significance in evaluating the performance of a commercial property. Cap rate is one of the most commonly used metrics in commercial real estate worldwide, but it's also the most abused and misused metric. We at XP Commercial define cap rate as the investment measure used to determine the value of an income producing property. CAP is calculated by using the property's 1 year net operating income, or NOI, and dividing it by the value price of property. Cap rate is often misused to calculate a return on the investment, but it does not calculate a return on the investor's equity investment. It is used by appraisers to determine value based on comparable property sales using cap rates from comparable properties that have sold recently. The appraiser that will then apply the market cap rate for the subject property in order to determine the value of the property for a given point in time. Brokers and property owners also use the cap rate to determine the value of their property at a specific point in time as it relates to the current net operating income of the property. Cap rate and value have an inverse relationship, meaning when cap rates increase, the price or the value of the property decreases. Cap rate is typically used when purchasing the property and a second time when valuating the property at the time of sale. Cash on cash, however, is another popular metric used to evaluate the performance of commercial real estate investments. This investment measure is calculated using the annual before tax cash flow for a given year divided by the initial investment. We compare the cash on cash return to a dividend return as it does not consider property depreciation or sales proceeds upon the sale of a building. It is the percent return on the cash flow from operations of the property in relationship to the original initial investment at the time of purchase. It represents the amount of cash an investor receives from their investment as a percentage of the cash they had invested. Cash on cash is calculated by dividing the cash flow before tax by the investor's initial equity investment. Both cap rate and cash on cash are important metrics in evaluating commercial real estate investments. However, they should be considered in isolation as they both have pros and cons. Cap rate provides a quick and simple way to assess the value of an investment, making it useful for comparing different properties. However, it does not consider the actual equity investment or financing structure of the property. Cash on cash, on the other hand, takes into account the financing structure of a property and provides a clearer picture of the return an investor can expect to receive on their investment. It is useful for investors who want to know the annual dividend return they will receive after factoring in mortgage payments and other expenses. However, it does not provide a complete picture of property's financial health, as it does not consider the growth of future cash flows or property appreciation. Some commercial real estate professionals argue that the cap rate is the same as the cash on cash return when paying cash and not financing the property. This would only be the case if there were known costs incurred to acquire the property, such as legal, recording, and title fees. And there was no expense that is not included in the NOI, such as capital expenditures, funded reserves, leasing commissions, all of which are deductible items. And acquisition costs increase the required equity investment. When teaching cap rate, we'd like simply to say that the cap rate does not care about the investor's money, whereas cash on cash considers the investor's equity and 1 year cash flow distributed. In conclusion, since cap rate and cash on cash are both important metrics in evaluating performance, investors should consider both metrics when evaluating a property and make sure they're comfortable with the financing structure before investing. It is important to understand that no single metric provides a complete picture of a property's financial health, and investors should always perform a thorough analysis before investing in any commercial real estate. Now, if you're in need of an experienced commercial real estate broker, I can be reached at 281-222-0433, or you can visit here to schedule a consultation. Calendly.com/Viking Enterprise. Thanks for your time and have a great day.